Welcome back. Indian equity indexes, large or mid-cap indexes, have delivered only about 6 to 7% returns in calendar 2025. The second quarter earnings of FY26, that is, have not quite been able to trigger a market-wide rally. But are the earnings at least showing signs of bottoming? Elara Capital has just put out a report stating that Nifty EPS rose only 6.8% in the second quarter, and for the full year will deliver only 3% EPS growth. But they expect Nifty EPS to grow by 14% in FY27. Elara also points out that mid-caps have done far better. Now, to get a sense of whether the worst of earnings downgrades is over and which sectors show maximum promise in calendar 2026, I have with me Harendra Kumar, Managing Director, Institutional Equities at Elara Capital. Harendra, good morning and thank you very much. We're meeting after a pretty long time on air. Well, first up, that's the question really which is bedeviling the market, confusing investors. Is the worst of earnings over? Are you seeing, a reasonable, steady earnings growth from here on?
Yes, pretty much. I think the good part is that we caught this trend reversal early on before the results in our preview note. And we said that sequentially, the single-digit earnings is going to trough out and you're going to see a rebound in earnings from Q2. So while the Nifty earnings are tepid, our broader Elara Capital company coverage, which is around 300, seen a good PAT growth of 13.5%. And this is largely coming from mid and small, which has surprised even the large caps. So there is a broadening of trend in the earnings, which is clearly being seen from the numbers. Now, this trend is going to become stronger as we progress into the next year.
Okay.
What is driving this is, of course, our rebound in our nominal growth, which will set in. That's the point we're trying to make.
Okay, Harendra, I'm coming to that in just a bit. I mean, that's the most important thing that people want to ask. But this confusion between Nifty and the broader market. Your report says Nifty grew by 6.8% EPS in second quarter, but for the full year, you're expecting only 3%. So Nifty hasn't quite bottomed out, even if the, non-Nifty stocks have?
Yes, if you see, because the calibration is the Nifty is dominated by the financial sector index, which is still seeing a calibration with respect to the NIM margins and the interest rate resets. That will reverse in next year after the deposit pricing, the interest rate and loan pricing gets settled in. That's one very large important point that you'll have to see. And of course, you will get a reset on the IT earnings as well, which is a significant portion because of the rupee depreciation and the rebound. So when you have two large market weights moving upwards, you should see a natural growth. And third, of course, you will have the consumer discretionary, which has picked up with the autos and some of the discretionary spends, will get a continuous fillip going into next year with the pay commission, which is larger than the GST tax cuts or the regular tax cuts that the government gave this year. So all in all, there are multiple triggers for earnings in various sectors to play up.
Okay. No, I take your point on Nifty being kind of weighed down for the current year, even in the second half, by the financials, which I think is about, 35% of the Nifty weight. So that would weigh down. So should one look more at mid-caps? Is that the place where the growth is?
Yeah, absolutely. If you see, where did the mid-caps start to flounder? Mid-caps are, lower down the food chain. Once you tighten liquidity on the large caps, it actually flows down to the mid and small. So when the RBI started tightening, from all sides and the flow down of the correction set in the mid caps. Now, as the liquidity start to ease up, it will start flowing into the profit margins of mid caps and all caps. So clearly that is what is being seen in this current quarter earnings as well. And this trend will continue. And remember, there is this broadening of the market where the mid and small caps are in fact adding more value than large caps because of the availability of capital and productivity gains. So that's where we see higher earnings growth coming up. So in fact, we have put out in a note that our preferred picks are mid caps first, large caps, and then small caps. So if you're looking for hunting to create more alpha for next year, I think you should start looking very aggressively on the mid cap side.
Okay, that's helpful. And that line of yours from your report is flashing as you speak. Let's then concentrate on sectors and stocks. What would your top three sectors be? in terms of earnings growth and even stock price growth?
So first and foremost is, of course, what we've seen is we've spoken on financials. Financials form around 34% of profit weight, Nifty weight. And it is also heavily FI owned. So what we're seeing is with the return of the earnings for the financial sector, the FIs will also start buying the financial space. And this is quite under-owned, and the valuations are quite converging to where the fair value multiples. If you look at the private banks per se, you're getting larger names at 2.2, 2.1 times. And if growth returns, the multiples should expand. So we see, a good play in private banks at there, given that PSU valuations are kind of converged to private banks. So, if you see what's weighing down the Nifty is the private bank earning re-rating. Pretty much all the three large banks have not delivered anything. Even in fact, the stock prices are pretty much matching the earning growth, or they're trailing the earnings growth.
Okay.
So if the growth comes back, there will be a re-rating there. So that's position.
Yeah.
As rates ease and liquidity eases, NBFCs will outperform the larger ones as well. So what we're saying is the mid banks and NBFCs and some fintechs in a easing liquidity environment tend to do better.
Okay. Got that. So those would be three of your bets in the financial space in 2026. What outside? I mean, one hears a lot of buzz on power. Several parts of the power cycle have done well. Is that a space you like? It is one of the better performing indexes, energy index in 25.
That's correct. So I think power is viewed as utilities, but I think it should now be seen as a growth sector. Given that as India's manufacturing sectors get a little better aligned, we have now new data centers coming up. The power requirement growth is going to go on an uptick. And if you see the capex announcements coming up with new data centers in Vizag or by other players, it's a given now. Now, along with that, the government is triggering the Nuclear Power Act, right? So it's going to, in the budget session, probably take up the inclusion of private companies to run nuclear power projects, the SMRs. Now, this will lead to a renewed capex cycle as well. So what we're saying is that the power sector capex that had pretty much stalled, for some reason, will get a new cycle, a new breath of life.
Okay.
So that will play up on cap goods, the financiers, the exchanges. So its value chain is as much like auto ancillary. So if you trigger power sector, it works on the economic, different sectors down the
Fair
line.
point. Yeah, fair point. Okay, let me come to, what's the fashion of the day. E-commerce companies, as well as, the recent IPOs. In your list, in large caps, you have Eternal, and in small caps, you have Delivery. Otherwise, I don't see too many of the, newfangled or lately listed IPOs, like, say, Grow. I don't see Lenskart. I don't see a lot of the newly listed ones. You're not still enamored by these new listings?
No, so we have a very basic methodology of how we assess value. We have anchoring value, which is pretty much the net worth of the company. We have short term, and large part of the value of any stock comes from the terminal value. Now, I can give you umpteen examples. So you can say, for example, one asset manager trades at 2,500 crore PAT and a 1 lakh crore market cap, which is around 45, 50 times multiple. And you have a new IPO which is coming at 0 PAT at 1 lakh crore multiple. So the new listed company, we are not against the newly listed company, but it will take years to come to 2,000 or 2,400 crore PAT before the 1 lakh crore market cap is justified.
Okay.
So you could see the time value killing the returns for investors who enter at this price point. We'll be happy to look at the opportunity at lower multiples.
Okay.
So that's pretty much the premise. So it's not that they are not great businesses or great entrepreneurs. It's the price at which you want to buy. So in that context, Eternal, if you look at its journey from the IPO, it fell first. Its fortunes turned only after it did Grofers, which turned into Blinkit and the subsequent re-rating, where the actual TAM and growth opportunity, the terminal value aspect started to play into the price. Right? So we are very cognizant because of the growth aspect in the formula and the ability of the management to deliver the ask rate. Let me tell you, execution is the most toughest in e-commerce. There is one leg of growth, whether the terminal value will play up is the point. So we
Okay.
keep making assessment. So in
Okay.
our case, Eternal has gone through the pain. It's reestablished new model
Yeah.
and growing from here. So also delivery. We see a strong turnaround in earnings.
Okay.
It's actually return to profitability.
Yeah.
The new acquisition is a turning point, and
Okay.
from here it will compound at a steady rate.
Okay. Okay. Actually, I'm sorry I'm rushing you because I'm a little disappointed also that, or disappointed as in surprised, that Paytm and PB Fintech are not there in your list of financials. You have Kotak Mahindra Bank. If you can comment on that very quickly, but more importantly, you prefer realty in a big way. You have got both Oberoi and Godrej Properties.
Yeah, I'll start with the realty piece because I'll tell you in the financialization of India's savings, real estate is a very large piece that people miss out. We all know the mutual fund and the AI story, but fundamentally, as per capita income goes up globally, be it Japan, be it US, real estate is a large variable. As people go for second homes, luxury homes, we've had, in this from January, we've had 2, 3 sharp drawdowns, but actually the pre-sales and the selling has picked up in a big way
Okay.
across all markets. Even the cash flow conversions are very strong. So we see a disparity between the true value and what the market is trading in. So there is an arbitrage. Stocks are closer to NAV and it will compound at a strong rate. So I think there is a dissonance
That
in the.
explains, yeah, the realty piece. Okay.
With respect to Paytm and PB Fintech, again, like we said, so the earnings, for some of these fintechs, we love both of them actually, but it's just that in the list of names that we have to put up, maybe some others got more preference over there.
Okay.
Personally, I feel that the AI play is going to work big time on fintechs in reducing the cost to income ratio. So be it what is being announced in Paytm with respect to the AI adoption and the reduction in the cost to income ratio will play up in all NBFCs and fintechs. In fact, we are very cognizant of that, and we actually working with a lot of corporates to figure out how the tailwind will work in their cost to income and adding to the bottom line.
Okay. I think I'll have to invite you yet again for a discussion on that as well. I'm a little intrigued that you have only Kotak Mahindra Bank. The usual list we get is ICICI, HDFC Bank, and Axis, but we have to postpone that discussion for another day. More interesting is really how will AI evolve or change the fintechs, and therefore what should we be invested in ahead of the curve? That discussion for another day. Harendra, thank you very much for a very interesting conversation. We have to wrap up on Bazaar. On that note, Chartbusters coming.